If you want to invest in ETFs but just aren't sure which ones are the best options given the present tumultuous financial climate, then look no further. In this video, I'm gonna review my favorite ETFs to invest in right now. We'll go through each one, look at their industry makeup, look at their performance, and pretty much just have a whole lot of fun. Are you ready? Let's do this! Exchange-traded funds, or ETFs, are single funds that have a basket of stocks in them. When it comes to investing, ETFs are a good way to build long-term wealth because they are generally low-risk investments that help you diversify your portfolio. Not a lot of people know this, but ETFs are often better than index funds due to their tax advantages. This is because the mutual fund manager usually has to rebalance the index funds themselves. When they do this, they make capital gains and have to pass those gains onto their shareholders. In an ETF, this doesn't really happen, so an ETF is more tax-friendly than an index fund. Of course, it goes without saying that you should always do your own research and never take a random YouTube video's investing advice. Due diligence is key. Okay, with that little knowledge nugget and caveat out of the way, here are the top 3 ETFs that you need to check out. At the top of our list is the Vanguard S&P 500 ETF, stock ticker VOO. It invests in the 500 largest US firms with great long-term growth potential. It owns 507 different stocks, like Apple and Google. One share is currently worth $362, and the average price-to-earnings ratio is 4.26. In 52 weeks, it has gone as low as $337 and as high as $436. This massive fund has $709.8 billion in assets and a dividend yield of 1.62%. This ETF had a lot of growth in 2021, but a pretty big drop this year. It has a year-to-date daily total return of negative 8.94%. This signifies a loss of invested principal, but the daily total return for the past year is 16.44%, and the daily total return for the past 3 years is 17.69%. which shows that VOO has done very well over the long term, except for one bad year in 2018 when it lost 4.42% of its value. Consumer consumption, financial services, healthcare, communication services, industrials, and technology are VOO's biggest sectors, with technology being the highest at around 24%. Since VOO invests in the 500 biggest US corporations, investors can expect a measure of protection from market volatility. This kind of diversification is helpful, especially during a bear market. Another good thing about VOO is that it has a low expense ratio of 0.03%. So, for every $1,000 invested, you pay 30 cents in fees. Because of its low fees, VOO is the best option when it comes to investing in S&P 500 ETFs. Number 2 on our list is the Invesco QQQ Trust, stock ticker QQQ. This ETF follows the Nasdaq 100 index. It is comprised of technology firms at the forefront of long-term development, including augmented reality, cloud computing, streaming services, and electric cars. Invesco QQQ is worth about $301 per share. Its average price-to-earnings ratio is 4.0. Its 52-week low was $269, and its high was $408.71. They have net assets of $152.73 billion, an average yield of 0.46%, and an expense ratio of 0.2%. A year or so ago, QQQ was worth about $350 a share. It grew very quickly in 2021, reaching highs of over $400. Since the beginning of 2022, there has been a big drop, but recently, it has started a bit of a recovery. It is close to its 3-year low of $265, which means it might be a good time to buy this ETF before it starts back up on an upward trajectory. QQQ has historically done better than the S&P 500 index because it's tied to huge technology businesses that are leading long-term growth that will transform the world. Technology makes up 45.71% of the market, followed by consumer cyclical, consumer defensive, healthcare, and communication services. This ETF has a strong chance of making money in the long run, since the biggest corporations can handle tough times, like the recent pandemic-caused market collapse. Overall, it's a great ETF that's very popular with investors, and one you should keep an eye on. And the last on the list is the ticker symbol VUG, or the Vanguard Growth ETF. VUG keeps an eye on 265 stocks, which have a median market capitalization of about $330.4 billion. As the phrase large cap suggests, these are some of the biggest companies in the world, like Apple, Microsoft, Amazon, Tesla, Nvidia, Meta, and more. Currently, VUG is worth around $239 per share and has an average price-to-earnings ratio of 5.22%. In the last 52 weeks, it has gone as low as $213 and as high as $328.52. The fund has a net worth of $165.53 billion and a dividend yield of 0.58%. VUG was worth $299.58 a share a year ago. Its share went up to $310, dropped a little, and went over $320. It's a large growth fund, and this year's daily total return is negative 24.90. This is happening with a lot of high growth ETFs and equities, but its 3-year daily total return was 21.6%. If we look at the annual total return history, we can see that most years VUG went up, but there was a big drop in the 2008 market crash and the market drop of 2018. A lot of high growth ETFs haven't done well so far this year. But again, that is usually a good time to start buying, since a lot of these ETFs are now effectively on sale. Since VUG is a growth ETF that holds stocks from big companies like Apple and Amazon, it is expected to grow in the next few years. These big companies are fairly stable, which lowers the risk of investors, especially if you want a low-cost, long-term investment. A lot of these big companies could be undervalued right now, which means that now is a better time to get in. With a 0.04% cost ratio and an average yearly return of 11%, you'd have almost $200,000 if you invested $100 every month for 30 years. ETFs are one of the most popular investment vehicles for good reason. They're flexible, adaptable, and accessible for pretty much everyone. And if you pick the right one, they're pretty darn reliable too. But they're not the only investment option out there. If you're suffering from a bit of a FOMO and want to weigh all your options, then watch this video where I go into the details on the differences between index funds, ETFs, and mutual funds. See you there!